Central banks and bond investors spent a lot of the past decade worrying about the savings glut coming out of China, emerging markets and also petrodollars. Now there's a new concern. It might be over. Emerging markets led by China built up vast reserves during the boom of the 2000s. That came as they were recycling export earnings and capital inflows back into developed market assets, particularly US Treasuries. The total went from $1 trillion in 2003 to more than $8 trillion in the middle of last year. But since then, it's begun falling. Now, some of the recent drops due to the strength of the dollar, making the reserves that are held in euros and yen look smaller in dollar terms. But China, along with several other emerging markets, are now burning through their actual reserves in order to defend their currencies. Now, the scale of the selling is estimated tens of billions of dollars a month and ought to provide a constant upwards pressure on bond yields if it lasts. Indeed, some think that it could be part of the reason that bonds have been relatively calm amid the carnage in the markets over the past week. Now, usually in the short run, a heavy equity sell-off leads to a switch into government bonds, pushing down yields. And you can see that's exactly what happened last Monday when the Dow crashed. We've got the S&P 500 here, US equities in general in blue, and the bond yield down at the bottom there, the red line you can see, fell in sympathy. Now, after that, bond yields rose all the way back and stayed higher, coming back up here and really staying fairly static, even as shares moved around all over the place. And I should say that in order to make this a bit clearer, the chart only shows US trading hours, which is why you get these gaps in the bond yield, because the bonds, of course, trade all the time. Now, personally, I think it's more likely that bonds didn't react as much because they'd already moved earlier in the summer. You can see that here with the US yield in red. The drop had been going on really for quite a long time in yields coming down up till February, rising and then beginning to come down again over the past couple of months, while shares had only just suddenly reacted in the past couple of weeks. But there's definitely a risk if outflows from emerging markets and the disappearance of petrodollars force countries to sell off their reserves. Still, this wouldn't automatically be bad news. Reserves are circular. As private investors sell renminbi assets for dollars, the Chinese government can sell dollar assets to buy the renminbi, at least if it wants to prevent its currency from falling. If those investors are as cautious as the country's reserve managers, they'll buy the treasuries that China's sold. Nothing really will have changed other than the names of the owners. But if those private investors are willing to take more risk, they're likely to put the money to more productive uses, whether that's in equities, corporate bonds, or even apartments in Sydney, popular with many Chinese investors. A better allocation of capital should, at least in the long run, be better for the economy. So higher bond yields will go hand in hand with eventual stronger growth. But all of these are marginal effects, likely to be far outweighed, in the short run at least, by the fundamental forces pushing yields up and down, things like the jobs market or prospects for inflation. But the power of the reserves was clear in the 2000s. From 2004 to 2006, the build-up of EM reserves created, or at least contributed, to the Greenspan conundrum, with bond yields initially falling as the Fed chairman Alan Greenspan raised rates. I've got US interest rates here in blue. You can see the initial drop here in yields, which came as rates began to rise. Now, even when the Fed kept on hiking, rates really didn't go up that much. That period there saw yields really didn't go up that much. You can see bond yields over that period sort of stuck between 4 and 5%, even as interest rates went from 1 to 5%, which is a far more dramatic swing. Now, the causes of this are still debated, but the build-up of trillions of dollars of reserves, mostly held in treasuries, surely part of the explanation. If emerging markets choose to run their reserves down a very long way in order to defend their currencies, they should do, but it's far from certain, then the Fed might find that there's an extra upward pressure on yields just as it's considering raising rates again for the first time in 9 years.